Hello and welcome to News in Depth here on TVP World. I'm your host, Marie Cato. Global oil prices saw one of their biggest single-day jumps in history on Monday. This oil shock is being driven by the intensifying war between the US, Israel and Iran, which has effectively closed off the Strait of Hormuz. 20% of the world's oil is now trapped behind this blockade, and subsequently the prices for Brent and WTI crude have skyrocketed over 60% since the start of the war, peaking at nearly $120 per barrel earlier today. With me to talk about the details is Maciej Wilowski, TVP World's business reporter. Hello, and thank you for being with me today.
Hi, Marie. Pleasure to be here.
So before we talk about the details, let's see what people are saying about these prices today.
Absolutely.
In a week, the price for a litre of fuel rose 40 cents in this station. A slight increase has occurred. For now, it's slight, but on the highway, it's much higher. I've seen the prices for diesel have risen a lot. I expect the worst in the coming months, because obviously the chain will be hellish, both due to speculation and the actual shortage of raw materials. So at this point, we can only endure the situation, as we are at the mercy of a very particular people.
It is an unprecedented increase in the past few days, and I expect it to get even worse.
So everyone seems to be feeling it already. The war has driven up the fuel prices, with oil jumping 20% in early trading on Monday. So it's hitting its highest since July 2022. Analysts were expecting disruption, but was it to be expected to be this bad so soon?
Well, looking at various media outlets, Marie, the word that I keep hearing is unprecedented and also worst-case scenarios. So I think very few analysts were expecting a supply shock of this magnitude to affect the global oil market, because as we've seen, the price of crude, both WTI and Brent is the international benchmark, WTI or West Texas Intermediate is the U.S. benchmark, it's up slightly over 60% since the beginning of the invasion on February 28th. So this is one of the biggest short-term, let's say 10-day spikes in oil prices on record if you look at the historical major oil shocks that have occurred.
So the world is now experiencing the largest oil supply shock in history, losing 20 million barrels of oil per day. Major producers like Kuwait and the UAE are being forced to cut production. How long might this go on for, and what does it actually mean for the world?
Well, it all depends on the war aims that were enunciated by Benjamin Netanyahu and, of course, the U.S. President Donald Trump. The longer this conflict drags on and the longer that the Strait of Hormuz, which is arguably the most critical oil choke point in the world, where roughly 20% of the world's liquefied natural gas and crude oil pass through, the longer this conflict goes on, the more upward pressure we're going to see on oil prices, and hence the more disruption to global energy supply we're going to be seeing.
But we're also seeing global investor panic. So it's not just the prices of oil per barrel. Analysts are also saying that the worst is yet to come. Can you just break down this global investor panic? Like, can you break it down in layman's terms for us?
So, like I had mentioned before, the longer this conflict drags on, whether it's weeks, whether it's months, we could potentially see oil prices go as high as $150 a barrel, which would be near the all-time record set in 2008, if not slightly above that all-time high. Worst case scenario, crude oil could spike as high as $200 a barrel, and this would, of course, present immense disruptions for the global energy markets and for consumers globally. If you look at the soaring natural gas and oil prices that we're seeing, and in Europe in particular, the focus will be on natural gas, given the roughly doubling of natural gas prices that we've seen over the past couple of days with the shutdown of production facilities in Qatar, various LNG production facilities in the Middle East. So all of that will have a broad-ranging impact on the global economy and on consumers worldwide.
So if investors are panicking right now and the price continues to go up, what does that mean for other industries in the world?
Well, other industries, manufacturing, steel production, airlines, that's a big one, of course, all rely on dynamics in the oil market. If you look at the airline industry, for example, jet fuel or kerosene is one of the biggest fixed operating costs for airlines. It's about 20 to 40% of the fixed costs that airlines have to deal with. So if you have a sustained increase in global oil prices that goes on for even weeks or months, that could lead to a dramatic spike in the operating costs of airlines, which in turn would make air travel more expensive because airlines, of course, would have to pass on those costs to consumers and to passengers.
Well, we have so many people that are still stuck in the Middle East that want to come home. What's going to happen to them? What kind of prices do you think that they will have to pay in order to get out of the UAE?
Well, that's absolutely true, Marie. And if we look at major transport hubs and airports in the region, particularly Dubai International Airport, because Dubai is the busiest international hub when it comes to passenger traffic, and it's a major transport corridor between Europe and Asia. People flying, let's say, from Europe to Asia, whether it's to, for example, London to Beijing or London to Singapore, that major transit hub has been massively disrupted. And if you look at an airspace map of the Middle East, it has been completely... Certain countries in the region like Iraq, Iran, etc., have seen a complete, basically, reduction in their airspace in the past couple of weeks. And some airlines are more exposed than others when it comes to the routes that they have to the Middle East. It's interesting because the CEO of Ryanair was recently here in Warsaw, and Ryanair is one of the less exposed airlines out there. They operate primarily in Europe. And what Ryanair did, which not a lot of airlines were, you could say, fortunate to do or had the insight to do, is that they hedged their bets on the increase in oil prices. So they hedged. Hedging is kind of like a financial derivative that airlines use in order to bet against or secure themselves from any increase in the price of oil. So now Ryanair will be able to secure their oil at $67 a barrel as opposed to the current market price, which is above $100.
$67.
Yes.
Well, that sounds really cheap in comparison to what we're seeing right now. Now, I wanted to bring in a comment from Saul Kavonich, the head of energy research, regarding the energy market scenario that we're seeing right now and the Iranian revolution and the Arab oil embargo. Let's just bring his comment in right now.
This scenario where you're seeing an existential fight by the Iranian regime is the kind of doomsday energy market scenario that has been war-gamed since the 1970s, when we had the Iranian Revolution and the Arab oil embargo creating oil price shocks.
So what do you think of his comments, and how does it...
Well, I think it fits with the reactions of a lot of market analysts. As we were mentioning earlier, so many economists and energy analysts were not expecting just how big this disruption would be. As I mentioned before, it was really the worst case scenario, or even beyond the worst case scenario, because very, very few analysts were considering this kind of market disruption, which is on par with the energy crises that we saw in the 1970s, with the oil embargo of 1973 and 74, where oil prices practically quadrupled. And then, of course, with the Iranian Revolution of 1979, which we had a dual price shock as well. So this kind of goes back to the, draws parallels, you could say, to the crises of the 1970s, which were some of the biggest that impacted the global energy market in those days.
So we have the hindsight to compare this crisis that we're witnessing right now with that of past ones, and you mentioned the one of the 1970s. But nonetheless, we have day 10 of this war right now. We don't really know how far into the future this will go for. We don't know how vast this Middle East crisis will become. But what does this actually mean for regular European consumers? Because nonetheless, as we heard earlier in the show, we had people in Europe commenting on how it's already affecting them. They're aware that, you know, at the moment it's not great, but it can definitely get worse. What does this mean for regular Europeans?
Yes, so before we get into the direct impact on consumers, I want to mention one thing with the Strait of Hormuz, which, as we mentioned before, is a critical choke point for the global energy markets. Most of the oil and gas, both crude oil and natural gas that flows through that strait goes to Asia, to ports in Asia, over 80% as a matter of fact. Europe imports relatively less. Actually, the share is below 10%, but the primary impact on European consumers will be in the form of rising prices. So it's less of a supply shock for Europe than it is a cost shock, because LNG, crude oil, are globally traded commodities where the prices fluctuate based on global supply and demand. And with global prices skyrocketing, that'll directly impact European consumers, especially when it comes to natural gas, because we've seen natural gas prices in Europe basically double compared to the end of February. And that'll impact the cost of heating, of electricity, because natural gas is a major component and a major source of energy used in electricity and heating and running businesses. So that'll be the main impact on European consumers and on businesses.
You say the biggest impact will be on electricity and heating, but nonetheless, that translates into all sorts of other costs that regular consumers have to endure.
Among other costs, of course, as well. Obviously, fuel prices at the pump will go up with the rise in crude oil. We'll see gas or petrol get more expensive. Other fuels will potentially increase in price, like heating oil. So the overall impact on the energy space will be one of higher costs.
But nonetheless, we've had emergency meetings here in Europe, G7, and also the EU has been calling meetings. So there must be some sense that this is an unusual situation that nonetheless is going to impact Europe in a way that is unprecedented.
Yes, and I think these emergency meetings really speak to the gravity of the situation. Earlier today, we actually had an emergency meeting of G7 finance ministers held remotely, New York time. I believe it was 8:30 a.m. New York time. But there they discuss potentially releasing their strategic petroleum reserves, which would temporarily at least bring more oil onto the global market and reduce the supply shock at least somewhat, at least temporarily, because we saw that earlier today, the price of crude oil, both Brent and WTI in a similar range, rose as high as $119 per barrel, which again was the highest, as you mentioned, since 2022. But after the announcement that that meeting was going to be held, prices then declined to roughly about $100 per barrel and then stabilized roughly near that level.
So markets are very sensitive. They hate uncertainty. But as you say, the price dropped a little bit after that meeting. Can you tell us why that would have happened?
Well, markets like to look into the future. Markets are often a reflection less of the current dynamics and more of what traders expect the future to look like. So when you hear news of governments getting together and to potentially seek a remedy to the oil crisis, to the supply shock, that in turn provides a sense of optimism to markets, and that in turn is enough to even drive the price of oil down slightly, maybe lead to a slight rebound in global stocks, although we haven't seen that, of course, yet, with global stocks also being particularly badly affected with the crisis. But it reflects the source of how sensitive markets are to news, whether that be good news or bad news, and kind of like the short-termism of the market.
Well, you say good news or bad news. I don't know whether we should consider this good news or bad news, but Iran now has a new leader. Does that mean that there is some level of certainty that is also being introduced? Does this factor play a role at all?
So with the new leader that Iran just selected, I would say it's more of a continuation or even a hardlining of Iran's stance toward the U.S. and the West, because this new leader has vowed that there will be no peace, at least for the foreseeable future, and it's more of a hardline stance compared to either what the previous leader, his father, had. So I would say rather than providing certainty, it's more of a continuation of what was happening in the past few days, and if not a hardlining of the Iranian stance toward the West.
Now, the IMF, just to add another institution to the mix that is also providing some insight, has signaled to prepare for the unthinkable in regards to what is happening right now. The unthinkable in terms of policies and also in terms of what might happen in terms of global oil supply. What could that be in terms of what they might mean in terms of the unthinkable? What might that be, and how soon might it be upon us?
So the message that we heard from the IMF is that the IMF head, Kristalina Georgieva, came out and said that for every 10% increase in the price of oil, and we keep in mind we've already seen about a 60% increase, if not more, there will be a 0.4 percentage point increase in global inflation, meaning the more oil prices rise, the more of an upward impact that will have on global inflation, and the harder it will be for policymakers and central bank officials to regulate prices and to bring inflation under control. So that could potentially lead either to an inflationary spiral, that could lead to global recession, and reminiscent of the stagflationary type supply shocks that we saw in the 1970s.
Well, that definitely sounds quite worrying, to say the least. And there's also been some interesting news in regards to the Strait of Hormuz that not much is going through, but there are some Chinese tankers that are getting through. So some people are getting some special treatment. I wanted to ask you whether there are any details in regards to that. Do you know anything more?
From what I know, China is lobbying hard, at least with Iranian authorities, to get as much oil through the Strait of Hormuz into its ports, because China is one of the countries most heavily reliant on crude oil imports from the Middle East. I believe China obtains about 50% or close to 50% of all of its oil from that region. And with most of that oil trade cut off, that is a substantial amount of oil that they're not receiving. Now, granted, China does have substantial reserves of oil that they've saved up over the years for a rainy day, you could say. But over time, that stockpile is going to dwindle, and China could find itself in a severe energy crisis the longer this conflict drags on.
Right. So it sounds a little bit like China's getting some special treatment.
So I don't know the exact details there. Perhaps maybe with the partnership between Iran and China, something could be negotiated to allow more oil to pass through to Chinese ports. But as of right now, there is not much progress when it comes to that. So far, very little traffic is going through the Strait of Hormuz, whether to China, whether to India, or whether to anywhere else in the world.
Now, I just want to bring in one more expert opinion from Ewa Kruczkowska, who's the senior EU climate and energy reporter, in regards to perhaps how long this crisis might go on for.
We are in a situation where it's impossible to say how long the crisis will last, but we are already seeing that 1% of supply cut means 4% in the rise of oil prices.
So we are well beyond 1% of supply cuts. I mean, the amount of supply that is being cut is huge.
Yes, as we had mentioned, the Strait of Hormuz is responsible for about 20% of the world's traffic in oil and gas. So 20% supply shock. And I believe the previous statistic that you had mentioned, Marie, even in the 1970s, something like close to 5% was impacted. Granted, the global oil market is more flexible today than it was in the 1970s, allowing it to weather the storm at least somewhat a little bit more efficiently, but still 20% is a massive supply shock that the global market would have to contend with.
So where does Russia, and especially the war in Ukraine, how will this be impacted by all this?
Russia, it's, I would say, one of the biggest winners out of this conflict, which is ironic because Iran has long been a close ally of Russia in the Middle East, but Russia stands to gain the most from the diverted oil flows, because with all of the oil trade that has been cut off from the Persian Gulf and the Middle East, buyers like India and China, which are massive importers of crude oil, they practically import all of their crude oil needs. They will now seek out Russia and other markets in order to get that source of oil. So this will lead to kind of like a shift in trade flows when it comes to oil and gas, and Russia is one of the biggest providers to fill that gap, so to speak. That, and in addition to, of course, the rise in oil prices in general, which is a big boon to the Kremlin's budget, because the higher oil prices are, the more money they can make on the oil trade.
Okay, Maciej Wilowski will have to keep us updated with your analysis. Thank you so much for joining me.
My pleasure.
And that's all for News in Depth today. Thanks for joining us, and make yourselves updated with TVP World at all times. Thank you. Goodbye.